A lesson in panic selling in this week's fastest 4 minutes in finance. Hello and thanks for joining us. I'm Scott Inman. Well, we record this video on Wednesday mornings so that we give our crew enough time to do the production wizardry that they do in time to send it to subscribers' email inboxes on Friday morning. And you may be listening to the audio version of the Fastest Four, which airs on radio on Saturdays and is available on podcast. Now, I say all that to say a lot has happened in the stock market since we recorded last week on July 31st. The first 3 trading days of August were awful. Triggered by some disappointing economic data, the S&P 500 index dropped like a rock. Now, as we review the data, we were a bit perplexed. Yes, employment data missed on expectations, and yes, the ISM manufacturing data showed that an economic slowdown is happening. But that's been pretty clear for months. Not to mention, for the most part, investors have been excited to see disappointing data. The general sentiment has been that if the economy slows, the Federal Reserve will cut interest rates, which would help stimulate the economy and we would miss a recession. That's the so-called soft landing scenario. But this time around, the bad news was actually seen as bad news. Then, Monday, Japan raised interest rates. That was a surprise move and shook global markets, including the United States. According to our partners at LPL Research, this was due in large part to what's called the carry trade. This is when investors borrow in a currency with low interest rates and invest in a currency with relatively higher interest rates. It's like a margin call, forcing borrowed currency to be repaid. At its low point, the S&P 500 was off about 6.8% in those 3 days. The NASDAQ dropped 9.5% over the same period. There was likely some panic selling involved here. Investors were jumping off what they perceived as a sinking ship. But then came Tuesday, and so far this Wednesday, the day we are recording the video. In those 2 trading days, the S&P 500 has climbed back almost 3%, and the NASDAQ has reclaimed about 4%. So what's the lesson here? It would be expected that watching the market drop would make you as an investor want to get out of the market until things got more stable. But what if you did? Did you think things were stable by Tuesday and Wednesday? Not likely. So if you got out of the market as it was falling and didn't get back in time to get the bounce back, where would that leave you over a long period of time? The data suggests that the average investor underperforms the stock market by a significant percentage, mainly because they try to time the market. It's impossible to perfectly time the market because, as this week has proven, you have to be right twice. Remember, pullbacks and corrections are normal, even in good times. Check out this chart from LPL Research. From 1928 through this year, the S&P 500 index has averaged 7.2 3% or more dips per year, 3.4 pullbacks of more than 5%, and at least one 10% correction per year. Knowing when they will happen is less important than knowing that they will happen. Staying invested through the volatility is the best way to stay on track for your goals. Thanks for watching.
Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.